Most investors completely miss the $100,000 dividend secret that separates the wealthy from everyone else. And here's what nobody talks about. Once you cross this threshold, the math changes everything. Not in 30 years, not in 20. The shift happens immediately. See, Harry thought dividends were for retirees. 3% yields? 4%? Why bother when growth stocks exist? Then he discovered what happens when dividend income hits 6 figures annually. The acceleration curve becomes exponential. But there's a specific strategy the wealthy use that most people never learn. And today, I'm pulling back the curtain. Quick note, this isn't personal investment advice. Everyone's situation differs, and investments can lose value. Always do your own research before making financial decisions. Today, I'm revealing 3 things. First, the mathematical proof of the $100,000 inflection point. Second, specific Dividend Aristocrats building this foundation right now. And third, why traditional advice about dividend investing might be costing you millions. Here's what changes at $100,000 in annual dividends. You're generating $8,333 monthly without selling a single share. That's more than the median American salary. But the real secret? At this level, reinvested dividends alone can buy significant positions in new income streams. Harry discovered this accidentally when his investment portfolio hit this milestone. He was checking his brokerage account one December morning. The dividend payment notification showed $8,412 for that month alone. That's when everything clicked. Think about it. Most people work 40 years hoping to retire. But with $100,000 in annual passive income streams, you're already there. The work becomes optional. The stress disappears. But here's what really matters: the acceleration that happens next. Let me show you the compound interest effect nobody calculates correctly. When you're earning $10,000 annually in dividends, reinvestment might buy you 200 shares of quality dividend stocks yearly. But at $100,000, you're acquiring 2,000 shares. The velocity of wealth building doesn't grow linearly. It explodes geometrically. Harry's first year after hitting $100,000 in dividends, his income jumped to $112,000. No extra contributions, just reinvestment. Year 2 brought $127,000. Year 3 hit $145,000. The snowball was unstoppable. And this brings us to our first cornerstone investment, Johnson & Johnson, ticker JNJ, currently yielding 2.96% forward according to our data. But here's what matters: 34 consecutive years of dividend growth. The 5-year growth rate sits at 5.32%. The 10-year rate? 5.77%. Not exciting? Consider this calculation. A $100,000 investment generates $2,960 annually today. But with that growth rate, in 10 years you're collecting over $4,500 yearly from the same investment, without adding a penny. That's the power of growing dividends versus static yields. Now here's where Harry made his breakthrough discovery. He found FDVV, Fidelity High Dividend ETF. Current yield, 2.98%. But look deeper into the holdings. This fund owns Nvidia at 6.32% of the portfolio, Microsoft at 5.57%, Apple at 5.09%. You're getting growth and income. The year-to-date total return? 12.38% according to the data. The expense ratio? Just 0.16%. This combination of low fees and quality holdings accelerates the journey to $100,000 dramatically. Harry allocated 20% of his portfolio here, but everyone misses the real opportunity. REITs, real estate investment trusts. These are tax-advantaged accounts for real estate that must distribute 90% of taxable income as dividends. Take Realty Income, ticker O. They pay monthly dividends. Current forward yield, 5.43%. They've raised dividends for 31 consecutive years. That's consistency you can bank on. Harry calls it his second paycheck because it arrives like clockwork every month. Or consider NNN REIT. Forward yield, 5.62%. 34 years of consecutive dividend growth. These aren't just investments. They're income machines that pay you 12 times a year, compounding faster than quarterly payers. Here's the investment strategy that accelerates toward $100,000. Start with KNG, FT SIBO Vest, S&P 500 Dividend Aristocrats Target Income ETF. Forward. Yield, 8.88%. Yes, you heard that correctly, nearly 9%. But there's a catch. The expense ratio is 0.75%, higher than our other picks. The year-to-date return is 5.42%, lower than some growth plays. But for pure income generation, this fund delivers. Harry allocated 15% here specifically for the monthly payments. Now add DHS, Wisdom Tree US High Dividend Fund. Current yield, 3.27%. Year-to-date return, 10.12%. This fund holds dividend champions like Johnson & Johnson at 5.78% of the portfolio, Philip Morris at 5.70%, AbbVie at 4.98%. Blue-chip dividend payers with decades of increases. The expense ratio? 0.38%. Reasonable for active management. Harry put 20% here for stability and growth balance. Don't forget 1E. SPDR Russell 1000 Yield Focus ETF, yielding 3.04% currently. Year-to-date return, 7.56%. The 5-year total return? An impressive 117.40%. This fund targets the highest-yielding stocks in the Russell 1000. Perfect for boosting overall portfolio yield. But here's what most financial advisors won't tell you. The psychology changes completely at $100,000 in dividends. Harry described it perfectly. Below that threshold, every market dip causes anxiety. Above it, market corrections become opportunities. Why? Because you're buying with house money. Those dividend payments keep flowing regardless of stock prices. A 20% market drop? Your $100,000 in dividends buys 25% more shares. You're getting paid to wait for recovery. Let's talk asset allocation for reaching this goal. Harry's formula was surprisingly simple. 40% in dividend growth stocks like J&J, 30% in high-yield ETFs like FDVV and KNG, 20% in REITs for monthly income, 10% in cash for opportunities. This balanced approach delivered average yields around 4.5% while maintaining growth. Not the highest yield possible, but sustainable and growing. That's the key for long-term wealth building. The math becomes undeniable. A $2.2 million portfolio averaging 4.5% yield hits our $100,000 target. Seems impossible? Let me show you Harry's exact path. Harry started with $50,000 at age 35, adding $1,500 monthly to his retirement savings. Assuming 7% annual appreciation and dividend reinvestment, he crossed $100,000 in annual dividends by age 53. 18 years of consistent investing. But here's what happened next. Years 19 through 25 saw his dividend income double to $200,000 annually, without increasing his monthly contributions. The compounding had taken over. The snowball was rolling itself. Most people think linearly about financial planning. Save X dollars, retire with Y income. But dividend investing isn't linear, it's exponential. And $100,000 is where the exponential curve goes vertical. Consider the reinvestment power. With $100,000 in annual dividends and quality dividend growers yielding 3%, you're buying $3.3 million worth of income-producing assets earnings every year, without touching your principal. That's how the wealthy stay wealthy. Harry's biggest mistake? Not starting sooner. He spent his 20s chasing hot stocks, his early 30s in index funds. Good strategies, but they delayed his dividend journey. If he'd started at 25 with just $500 monthly, he'd have hit $100,000 in dividends by age 45. The opportunity cost of waiting is massive. Every year you delay is a year of compound growth lost, a year of dividend increases missed, a year further from financial independence. But there's another layer most investors miss. Dividend growth often outpaces inflation. Our J&J example? 5-year dividend growth of 5.32% versus recent inflation around 3%. Your purchasing power increases over time. Bonds can't do that. CDs can't do that. Only growing dividends provide true inflation protection. Harry's current portfolio generates $147,000 annually in dividends. His living expenses? $65,000. The excess $82,000 gets reinvested, buying more shares, generating more dividends. The cycle accelerates itself. This is how wealth compounds exponentially, not arithmetically. Here's the portfolio allocation that works. Start with quality over yield. FDVV gives you both 2.98% yield plus growth exposure through tech holdings. Add monthly payers like O and NNN for consistent cash flow. Their 5.43% and 5.62% yields provide immediate income while you build toward $100,000. Layer in the high yielders carefully. KNG's 8.88% yield seems attractive, but examine the sustainability. DHS at 3.27% might seem low, but the consistency matters more than the number. 1E at 3.04% provides broad market exposure with yield focus. The biggest mistake Harry sees others make? Chasing yield without checking dividend safety. A 10% yielder that cuts its dividend destroys wealth. A 3% grower that raises consistently builds empires. Financial goals should be specific. Not, I want passive income, but I want $100,000 in annual dividends by age 55. That specificity drives action. It makes the daily investment decisions clear. Every dollar allocated either moves you toward or away from that goal. The first $100,000 in dividends isn't just a milestone. It's where passive income becomes truly passive, where reinvestment alone drives meaningful growth, where financial independence stops being a dream and becomes mathematical certainty. The question isn't whether you'll reach it. The wealthy have proven it's achievable. The math is indisputable. The only question is whether you'll start building today or wait another year wondering what if. Harry's advice? Start now. Start small if necessary, but start. Because the journey to $100,000 in dividends begins with buying that first share. And every day you wait is a day of compound growth lost forever. The path is clear. The tools are available. The only thing standing between you and $100,000 in annual dividends is the decision to begin.